Let's take a broader look at the markets today with our first guest. We've got Ryan Payne, Payne Capital Management President, Payne Points of Wealth podcast host. Ryan, it's good to talk to you today. Give me a sense of where you think things are headed right now. As Brian said, it's kind of sort of the quiet time of year in the summer, but we're starting to see a lot of money move back into tech.
Yeah, I mean, there's been a lot of action this summer. And I'm typically optimistic. As you know, I'm optimistic right now because I think, the real theme this year is all you've heard about is economic slowdown, the big R word being recession. And I think the big R word is not recession, it's actually resilience. If you see, last week is a perfect example. The jobs report just came out. It was the hottest jobs report we've seen in a long time. We had, close to double what the expectations were. And now we're down to a 50-year low in unemployment. We know wages are going higher. And we know it's been 80% of companies that beat. So we've seen the market really rally on a lot of unexpected good news, I would say, over the course of the last month and a half. The S&P has rebounded like 13%. I was on your show about a month ago, very, very bullish. Not to say I'm prophetic, but I think the right decision here has been, not to give up on your equities and sit in cash and be afraid.
Ryan, at the same time, though, we love a little bit of optimism, but you've had some warning that the bear market rally could still present the presence of a bear that could end up ripping your face off, because it's true that the overall story about inflation weighing on this economy, which could tilt us in recession, is still very much the case. We'll see what happens when the CPI comes out tomorrow. But is there a sign, clearly in your view, that we've already reached a market bottom, or hey, not so clear yet?
Again, I don't have a crystal ball. I wish I did. But if my best guess is here, you probably have seen the bottom, because if you start looking out, projecting to the future, and that's what markets do, invariably looking at what's going to happen over the next 12, 24 months, is inflation is starting to come down, right? We've seen commodity prices come down. We're talking about the chip now oversupply. We had an undersupply of chips, and now that's why all these semiconductor manufacturers are having an issue, is because demand is starting to dissipate. So there's just not as much stress on supply chains. That's going to be very, very deflationary. And I think the bond market's already telling you, right? We're already looking at the 10-year Treasury somewhere around 2.7%. It was as high as 3.5%. So I think the reality of it is inflation's starting to come down. The job market is going to continue to stay hot. We have never seen a job market this hot. So wages are going to stay strong. And the Fed, they really have the ability here over the course of the next couple months to pivot, because we have another CPI reading next month. We're going to have another jobs report next month. So by the time September comes around, the question is, are they going to be a little less hawkish? And if I was a betting man, I'd say I think they are, because clearly the signs are that we are starting to cool off. And that's essentially what they intended to do, is to cool the economy off. And it's starting to happen.
Ryan, you said you're bullish right now, but, I was saying this morning, I've never known you to be not bullish in the markets. You're generally a positive guy. You're pretty defensive because you are more value oriented. What would it take for you to kind of change your view? What are some of the risks or potential red flags that you're looking for that say, well, maybe this could change the direction a little?
Well, I think here's what's the dangerous component right now is if you look what's led the market, Akiko, over the course of the last month and a half, and I'm going to talk about this on my podcast this week, Payne Points of Wealth, maybe the greatest financial podcast in the country, but is tech has led the way here. And you're seeing a lot of money. I probably review over 50 portfolios a month. A lot of money is going back into tech, and tech is still overvalued. I think we're still going to be in a higher inflationary environment we were the last 10 years, and you're seeing this with the chip makers now. They're getting hit. They had a nice rally, and now they're getting hit again. So I think putting your money into tech and concentrating in tech is not a good decision. Don't ride the momentum here. You want to diversify. And this happened when the tech bubble burst. You saw the NASDAQ stocks go down something like 70% of NASDAQ stocks went down 50%. But then they had a huge bear market rally where they went up like 30%. Everyone piled back into that tech trade. And then tech went down 80% from there. So I think, we talked about the meme stocks today on your show and just all that speculation there. You're starting to see Bitcoin go up a little bit here again, too. The animal spirits are out. I would say here that's probably short-lived. And if inflation does stay stronger, now I think it's going to come down, but I think it's going to be a lot higher than it was. That's not the environment that tech stocks with valuations that are still relatively high are going to really, really shine. That's where those old school value stocks that I talk about a lot are going to do better, that have pricing power, and those profits are more in the immediate.
So I guess looking forward, right? I mean, because I imagine the interest rate environment plays into some of that thesis as well. If it is indeed the case that maybe higher interest rates will kind of put a little bit of a dent into these tech companies, we're already seeing them start to lay off. But what is the bigger economic story then beyond the Federal Reserve itself? Like, what econ data are you watching? I know that the jobs report last week was something that you were watching very closely.
Yeah, I think it's just where consumers are spending their money right now. And you're seeing that during this earnings season. I think there was a stat out today, just if online goods are down about 1% in price from where they were a year ago. So I think what I'm really looking at is where's the consumer behavior? We know consumers are continuing to spend no matter what those other economists and strategists told you. I'm always confident the American consumer is going to spend. We love to spend money here in the U.S. So I think that trend's going to continue. It's just where's money being spent in the economy. And if you look at it, it's going to be more hospitality, right? It's people are going out again. They're eating out again. They're traveling. And you're looking at where we have labor shortages. It's in those places like hotels, anything that's service or leisure. So I think it's really about where is the money flowing. And I also think it's about, again, that I think that employment data says everything. We've never had a recession while unemployment was coming down. And unemployment was always going up since the post-World War II era, where we've seen actually a real recession. I mean, we know we've had one technically, but I think the real reality of it is, things, again, are resilient. We're not really going into this huge, dire economic slowdown like you're hearing a lot of people on Wall Street say.
Ryan, quick question on energy. And obviously, we're coming off of another quarter where big oil companies have seen record profits. I know you've liked the space for some time, but there's questions about whether, in fact, we have reached the peak as we see some of the prices come down. What do you see?
I think energy is the new tech. If you look at profits this year in energy, they're going to be double what technology is. They have the highest dividend in the S&P 500. Multiples are still cheap. And I always say, peak energy demand or fossil fuel demand is not for another decade. We haven't built a new refinery in this country in 40 years. So we may get a pullback here short term. Oil prices have come down a little bit, but I think energy companies are poised to have a very long rise here. So I think that's going to be a core component to your portfolio, a tremendous inflation hedge. And again, I think inflation is going to come down, but it's still going to be heightened versus what we've experienced for the last decade. And that's critical here. It's just a different paradigm than we had the last 10 years. That's why tech's not the place to be anymore.
Yeah, Ryan, something tells me you're going to stay bullish based on what I see behind you. BeBullish.com. Ryan Payne, Payne Capital Management President and Payne Points of Wealth podcast host. Appreciate the time.